Are you preparing for a financial analyst interview? In this video, we'll cover the top 5 interview questions every candidate must be ready for, and how to answer them with confidence. Before we begin, don't forget to like this video and subscribe to WRichMindset for more finance and career insights. Question 1. What is EBITDA? Let's start with a classic. What is EBITDA, and why is it important? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It helps analysts measure a company's operational profitability, without the noise of financing decisions or accounting adjustments. Why does it matter? 2 main reasons. Operational focus: it shows how the core business is performing, independent of financing and tax structures. Comparability: it allows fairer comparisons between companies in the same industry, especially when debt levels or tax policies differ. That's why EBITDA is widely used in valuation multiples like EV/EBITDA. Question 2. How are the 3 financial statements connected? Next, how are the income statement, balance sheet, and cash flow statement connected? The key link is net income. From the income statement, net income flows into retained earnings on the balance sheet. On the cash flow statement, net income is the starting point for calculating cash from operations. Non-cash items like depreciation connect PP&E on the balance sheet with expenses on the income statement. Changes in working capital, like receivables, payables, or inventory, also flow through the cash flow statement. Together, these statements give a complete financial picture of a company. Question 3. How would you value a company? A common question is, how would you value a company? The 3 main methods are: discounted cash flow, DCF, projects future cash flows and discounts them back using the cost of capital. Free cash flow to firm, FCFF, discounted at WACC. Free cash flow to equity discounted at cost of equity. Terminal value often calculated with Gordon growth model or exit multiples. Comparable company analysis: compare valuation multiples, like P/E or EV/EBITDA, to similar public companies. Precedent transactions: look at prices paid in past acquisitions of similar businesses. DCF is detailed and forward-looking, while comps and precedents give a real-world market view. Question 4. Explain Porter's 5 forces with Walmart example. Another tough one: explain Porter's 5 forces, and apply it to Walmart. The 5 forces are: threat of new entrants, bargaining power of suppliers, bargaining power of buyers, threat of substitutes, rivalry among competitors. Now, for Walmart, the threat of new entrants is very low. Why? Because Walmart's massive scale, global supply chain, and strong brand make it nearly impossible for new players to compete at that level. Question 5. Which stock has more growth potential, $5 or $100? Finally, which stock has more growth potential, a $5 stock or a $100 stock? The correct answer is, it depends. Stock price alone doesn't show growth potential. For example, a $5 stock with 500 million shares equals $2.5 billion market cap. A $100 stock with 100,000 shares equals $10 million market cap. Clearly, the $100 stock could have more room to grow. What matters most is the company's business model, revenue growth, and market position, not just the share price. And that wraps up the top 5 financial analyst interview questions you need to master. If you found this helpful, hit like, subscribe to WRichMindset, and stay tuned for more practical finance and career tips. Good luck with your interview, you've got this.